Ash in the white goods segment with its acquisition of Lloyd's Electric consumer business for 1,600 crore rupees announced over the weekend, which will help the company sell air conditioners and washing machines. But the deal may actually exert pressure on its margins and cash flows, at least in the short term. Anisha Jain and Anshu Sharma and Shireen Bhan bring us this report.
Havells' acquisition of the consumer durables business of Lloyd Electric will give it entry into the white goods segment, a category that's seen a growth of 50% over the last few years for Lloyd. But the space is dominated with top brands like Voltas, LG and Panasonic, and so market experts believe the deal may risk a dilution of margins and impact cash flows, at least in the short term.
Entering into the white goods business at this point of time, which is highly competitive, and Havells need to do a lot of homework before getting a good margin on this business. And Lloyd, as such, it is a very cheap brand so far the AC business is concerned. And also it is doing a lot of outsourcing particularly from China and other countries. Manufacturing, which is Havells Ford, I can say the strong point of Havells, it is not there in Lloyd's. So on that basis, I feel this is earning neutral, but value decreative for Havells.
The management differ from that point of view. Havells says the air conditioners business of Lloyd is growing strongly and hope to improve margins over time. The company claimed the deal will be neutral for earnings per share during FY18 and become accretive starting 2019 financial year.
We believe in the first year it will be EPS neutral, and going forward, yes, it will be EPS accretive. Lloyd has resurfaced its consumer brand in the last 8 to 10 years and has grown at a CAGR of almost about 50%. We believe now it's at the cusp of taking forward not only the growth but also expansion in margins. The industry per se is an industry where companies have been making double-digit margins, and we believe that Lloyd can also get into that journey and come closer to the Havells margins in the next few years.
Havells can sustain a longer gestation cycle for better margins as it pushes ahead with its new line of products. Although its cash reserves stand at 1,400 crore rupees, the deal is likely to be funded by a mix of internal accruals and debt of around 500 to 600 crore rupees. But market experts stay cautious. Brokerage firm Citi believes that the deal is marginally negative to neutral on post-tax profit and EPS for FY18. In New Delhi with Anshu Sharma and Anisha Jain, this is Shireen Bhan.